Every single person who invests, sooner or later, has to answer a question. And it's not about what stock to pick next week. It's a much deeper question. What do you really want your money to do for you? How you answer that is going to shape your entire financial life. And at the very heart of that decision are these two simple words: growth or income. These aren't just investing strategies. They're two completely different ways of looking at the world. And today, we're going to explore both of them, using two of the biggest ETFs out there as our guides, VOO and SCHD. So just imagine you're standing right here at a fork in the road. And this isn't just about the numbers. This is personal. The path you end up taking has to match your personality, your age, and honestly, what's going to let you sleep at night. Okay, so one path, it goes straight up a mountain. Now, the climb is going to be tough, it's going to be volatile, there will be storms, but the whole point is that view from the summit, the potential for the biggest possible portfolio value way down the road. This is the path of growth. Then there's the other path. This one wanders through a quiet orchard. Here, the goal isn't some distant peak. It's about harvesting fruit consistently. We're talking about actual cash payments, season after season, without ever having to sell the trees themselves. This is the path of income. All right, let's walk down that first path together, the path of growth. And our guide for this journey is an ETF called VOO, which is designed to mirror the S&P 500. So what is that really? Well, think of an S&P 500 ETF like VOO as a single basket. And inside that basket is a tiny piece of the 500 biggest, most powerful companies in America. With just one purchase, you own a sliver of the entire engine of the U.S. economy. And this chart, wow, it really tells the story of that engine. You can see that over the last 100 years, the trend has been just relentlessly up. But, and this is a huge but, look closer. It is not a smooth ride. You see those gut-wrenching drops? 1987, 2008. The path of growth demands that you can stomach those storms without hitting the panic button. And that right there is the real test. It's a psychological one. A growth strategy requires an incredible amount of patience. You don't really get a paycheck from it. Your reward is just a number on a screen. And your one job is to trust that the power of compounding is going to make that number much, much bigger, 20 or 30 years from now. Okay, let's change gears. Let's go explore that other path, the orchard of income. And for this part of the journey, our guide is the ETF known as SCHD. Now, a SCHD is a totally different kind of basket. It doesn't just hold everybody. It holds about 100 U.S. companies that have been handpicked for a very specific reason. They have a long, proven history of paying their profits out to shareholders, and they look like they're strong enough to keep doing it. The key words here are quality and sustainability. And what kinds of companies are we talking about? Well, you'll see a lot of them are in sectors like energy or consumer staples, healthcare. I mean, think about it. These are businesses that sell things we need, whether the economy is good or bad. And that stability is exactly what allows them to pay those consistent dividends. This number, this is the fruit from the orchard. It's called the distribution yield. But put simply, it's the percentage of your investment that the fund paid out to you in cash over the last year. It's not a theory. It's not a paper gain. It's real, tangible income.
And this table here, this shows you the rhythm of income investing. Just look at those dates: March, June, September, December. It's like clockwork. The numbers on the right, that's the actual cash that gets paid out for every single share you own. It's a predictable deposit right into your account. It's the feeling of getting paid by your investments.
And the feeling here is completely different from growth. This isn't about faith in some distant future. It's about the security of seeing cash coming in right now without having to sell off your assets. It's this constant, tangible reward for being an investor. So let's do this. Let's put these two philosophies, these two completely different mindsets, directly side by side. It really just boils down to this. With growth, your entire focus is on accumulation, making that total number on the screen go up. But with income, your focus is on preservation and cash flow. The dividend itself, that's the price. So the growth path, it's often best for people who have time on their side. Younger investors who can afford to ride out those market storms for decades. And in really strong upward trending markets, this is the strategy that's built to maximize that final number. But the income path, this one often provides a sense of stability right when you need it most. So for retirees who actually need to live off their investments, or during those really choppy markets that aren't really going anywhere, that predictable cash flow provides a profound sense of security. Because even if the stock price is down, you're still getting paid.
And all of this brings us right back to the beginning, back to you, standing at that fork in the road. So, how do you choose? The answer isn't about which one of these funds is better. They're both fantastic tools. The real question is which journey fits you. Are you building for that spectacular view from the summit, way off in the future? Or do you need, or maybe just prefer, to enjoy the fruits of your labor along the way?
And ultimately, that's the real takeaway. This whole debate isn't about tickers on a screen. It's an internal one. It's about your personal timeline, how you handle risk, and your own definition of what financial success even looks like. The right path is simply the one that lets you sleep at night.